Good morning, everyone. Good evening, everyone. Excuse me. Welcome to Animal Markets webinar. Thanks for joining us. We're going to take a look at strategies for trading on daily timeframes, of course, today on this 1st of September, a new month going forward. We're going to be taking a look at different indicators and different systems in just a second. First of all, though, be aware of these two disclaimers. First of all, the fact that this is shown to a global audience but may not be suitable for everyone. Take a look at animalmarketsglobal.com, select your country of residence, and contact the appropriate entity for more details and information. Also, please be aware that trading for exchange of global financial markets is considered high risk and may not be suitable for everyone. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer, plus you are aware of the risk involved when trading. All right, today it's only going to be me. In fact, usually speaking, of course, Nenad and I are hosting this educational block on Thursday together. But Nenad is taking a flight, so he will not be able to join us today. We both are taking a bit of time off at the end of the tail end here of August. But despite that, we still have this webinar this week. Otherwise, it was a bit quiet this week, as you might have noticed. Next week, we got more webinars for you, though, as September starts to kick off. So with that said, we're going to take a look at various trading systems, various formations, 4 to be precise. In generally speaking, though, the parts of a trading system that I think are important, and this is certainly not everything, but you know, the core of a trading plan or system are these 5 things. Now, a trading plan itself goes further than that, all right? Then you want to take into account risk management. You want to think about trading psychology. When do you kind of see your weakness kick in? What do you think is your strength? How does your system kind of play into that? How can your system improve based on your own strengths and weaknesses, your own psychology? So yeah, you have to go further than than this in your trading plan. You want to cover a lot of ground. Um, and make it a bit wider than what I'm showing you here. But from a trading perspective, what decisions do you make to actually take a trade, right? I think these things are important. You want to analyze, obviously. Here you're basically planning a trade. So what you're looking for instance, what I do is I use this triangle to understand the market. So I'm looking for trend and momentum. I'm looking for support or resistance and patterns, basically. And within patterns, I typically look at 3 things. The CAN is for candlestick patterns, the CHA is for chart patterns, and the IV is for divergence patterns. All right, so those are the type of patterns I'll be scanning the market. There are probably a lot of patterns. That's the great thing about the markets today, that we can find patterns means that the information is structured in such a way that we can see repetitions. All right, if it were not structured, we wouldn't see any patterns, and we would not be able to use that to our advantage. Of course, one thing is to see patterns or to have patterns. Second thing is to use those patterns, of course, which is a different matter. But for analysis purposes, the patterns are important. Then I look at filters. How can a trade perhaps not materialize? Is there some news event? Is there anything like support or resistance, or that could block the trade basically from materializing? Then if that's good to go and I like the trade and the currency pair, I'm looking at what spot do I want to trade it? What decision zone is interesting for me? So if the price is moving up, for instance, like this, in uptrend, I'll be trying to understand where price would have to go to before I find it interesting. That's the decision zone, or perhaps break before finding it interesting. And once it gets into the decision zone, what is my trigger? So for instance, the 50 fib could be, I would want a price maybe to go back to the 50 fib, but how do I trade it once it goes back to the 50? I could have a pending order there, right? That could be very well the case, or I could wait for a candlestick pattern, or I could wait for a chart pattern on a lower time frame after it hits the 50 fib and then shows a chart pattern. So this is basically how do I trade it, where do I trade it, and how. Then of course the entry and exit and trade management. How do I trail it? How do I monitor it? and etc. So this is basically the core. The left side is planning a trade. Basically, the right side is trading the plan. When we plan a trade, we want to think about it. We want to carefully analyze. When we set up our trading system, we want to definitely think very cautiously about it. But when we're actually trading, we traders want to actually reduce that. We don't want to overthink it when we're actually trading. In that case, we have to give space for the part of the brain that allows us to act. All right, so actually thinking would stand in the way of acting. It would block us from actually following our plan. So that's kind of the irony here, is that we need to do both. We need to think beforehand and afterwards, but when trading, we want to focus on execution, focus on acting, and implementing, and not, carry on a theoretical debate about whether our trading plan is really the best in this form, or whether we want to tinker it a bit. That's a interesting discussion to have with yourself or your trading buddy, but not during trading. So with that said, today we don't have time to go through all of these points, basically, for each four of these ideas and systems. So we would have to have more time to go that elaborately into all of these aspects. But I wanted to discuss, generally speaking, these four: Fibonacci and candlestick patterns, the Alligator, AO, Keltner, and Candlesticks, moving averages and Candlesticks, and Ichimoku and CCI. So a bit of everything, as you can see. We have here 3 times we have candles, so as you can see, very important always. Once a fib, support and resistance level. Here we have basically moving averages, support and resistance, and an oscillator. Here we have moving averages, and here we have support and resistance and an oscillator. So this is a few of those combinations that are, I think, interesting to look at. So let's dive into that right now. Fibonacci and candlestick patterns, first of all. So very simple put. I mean, I have various Fibonacci strategies, or various ways I use Fibonacci levels. But on a daily chart, I think we can be very simple and keep it very much to the point. Mind you that this is, just to repeat the topic, it is looking at daily time frames. All of these four we're looking at, as the topic of the webinar indicated, we're looking at, one second, strategies for trading on daily time frames, just once again repeating that. So on a daily time frame, I think it's pretty easy to use fibs. I think we just want to use the recent swing high, swing low in both directions. It's fine. Even against the trend, it is okay. If you identify a trend, of course, you want to make sure that you trade with the trend without any doubt. But you can even have the counter trend fib as well on the chart, just in case you get a bigger correction visible on the chart. All right, so both are fine. Now, if you're in a range, if you identify a range as price going sideways and you see it, in that case, you either want to basically, like this, here's a range, for instance, where I have a green circle. You see that part? So that's the part where you don't want to place a fib on these particular movements, because then price is bouncing back and forth, and that's not a good spot. But what you could do is still put a fib on the bigger swing high, swing low, like this. All right, that's still fine, as long as we don't start putting fibs in that zone right there. But you can zoom out and use a bigger swing high, swing low, probably. If not, then maybe just better skip that pair. But typically you're going to find a higher swing low. So, very simply put, just naturally putting the fibs on these swing highs, swing lows is okay. Now, if you can't see them, these swings, it could be good to use a fractal indicator, because fractals will make it maybe a bit easier to see where those tops and bottoms are. So that's a tip that you could use. But basically what I'll be doing is looking for candlestick patterns at fibs. What I do basically is either a candlestick pattern or 2 candles back to back that are in the opposite direction in a way, or with the trend, let me say it this way. So what I mean of this is price is moving lower here, put the fib on the high to the low. We're looking for a reaction at these fibs. The reaction is either candlestick pattern or two bearish candles. Once again, we're looking for downside here. So I'm looking for the bullish candles to stop and the bearish candles to appear twice in a row. So that happens here, right there. So that's the bounce basically at the 61, or it's very close to the 78.6 fib in fact. So the bounce at these fibs basically, and that is the idea. The trade taking upon the close, the stop loss above the high, or the candle high, or the swing high, swing low. Both are possible depending on preference at that point, and targeting the fib levels right here. All right, so that's basically very simple way of trading fibs on daily chart. Now this is not something I think is good for lower time frames because there's too much, I think, volatility in a way. Maybe fibs are good on lower time frames, don't get me wrong, but you might want to be a bit more critical about when you use it. I think on daily charts it's easier to use, let's say, without extra confluence as a standalone tool. All right, so here you can see again basically a bounce at 61.8. Now in this case, the second candle brings us right away to the target. So in that case, of course, it's not a good idea to trade it if these two candles have already basically eaten up most of the movement. That's not, of course, that's too late. That can happen. That's okay. This one, though, that is a good entry and brings us right to the target here, minus 61.8. So that's a good trade. As you can see here, two bearish candles. All right, also brings us right away, not to the target, but brings us to the low. That brings me to the counter trend trade. As you can see here, when you put a fib from here to here, you see the bounce at the 88.6 fib. That could have been a reversal trade. You could also put fibs from here to here, but you see there were no two candles in this part, nothing. Check out that swing high, swing low, 0, 1 bullish candle. So no counter trend trade there. We could put a fib from here to here. Then we have two bullish candles here, but trade management, of course, you don't want to stick in too long. You got a lot of candles going sideways like this, so you want to trail stop that as well. Basically, you want to aim for the targets at first, but if price is struggling with breaking the bottom, you want to trail stop that, and you want to use candle highs or fractals to take the profit that is available. All right, we don't want to stubbornly hang in there to a trade for too long. If we put a fib from here to here as a counter trend fib, nothing happened because the candles broke the bottom without bullish candles. If we put a fib from here to here as a counter trend fib, nothing happened because the bottom broke without two candles. So using fibs on daily chart, let me show you here, is pretty straightforward. Let's see. One second. Oh, it's the dollar yen. Okay. It's pretty straightforward. We could basically fib them both ways. And obviously with the trend has a bit more potential, but occasionally a reversal trade is going to help. Divergence, if you see divergence, definitely, of course, an extra value there in taking a trade like that when divergence is present. So for instance here, we can fib it both ways. We can fib this swing high, swing low, and look for reactions at the fib. All right, that's one way. But at the same time, we can put a fib from here to here as well as a counter trend. I'll make it a different color. All right, and look for reactions at the counter trend, like the 61.8, for instance, right? Once we see two bullish candles there, typically, though, with counter trend, you want to wait for a bit deeper fib, typically, and not trade at 38.2 or 50. On average, it would go and retrace deeper, right? So here, two candle bounce at the 61.8, and indeed, boom, look at that. We got the reversal trade up to the minus 272. a target. And here we got good shorts as well, because why? Because that's a minus 272 target and the 78.6 fib. So that is also good shorting territory at the same time. So interesting, we have basically the opportunity to take a short here. That didn't go too well because price went sideways. So that could be a small loss or break even depending on the trade management. Here we get a counter trend trade that went well. Here we get a with the trend trade that went well as well. So as you can see that the fib, the counter trend fib sometimes works well, sometimes not. Here, for instance, if we put the fib from here to here, on the new swing high, swing low, waiting for the pullback, two candles. Oh, that's the one we already showed just a while ago, but so that I won't use that again as an example. But I think you get the picture here. You want to use natural swing high, swing lows. So this one could be one, for instance, right? Waiting for fib bounce, 38.2 fib bounce here. But then we can still put this one on and see if it breaks the top or not. If it doesn't and respects one of those fibs, there could be a bit of a bounce trade, retracement trade still as a bigger reversal. All right, so once we break the top though, of course, then we get rid of this fib. All right, and we can use a new swing high, swing low, wait for retracement like this here. And we get the bounce at a deep fib, two bullish candles. We can take the long right there. And a lot of candles don't break this top. So when that happens, of course, we want to move it to break even below these bottoms here, lock in some profit, and understand, of course, that the market in this case is showing weakness by not breaking the top. All right. So when that happens, we want to use. We have two fibs always. Remember, we have the with the trend fib. That's this. We have the counter trend fib too. That's this. So at that point, we see struggle at this fib, so we can take a reversal or reversal trade basically, and price reaches the target. So at this point, we can move the fib again to the new swing high, swing low, like this. All right, and that's the same situation we're looking for. Just a second ago, we used this fib already. We're looking at fib reactions here and here, and we had a counter trend trade here. So we're looking for basically swing high, swing lows in both directions. But if it's ranging, we want to skip it. Is that clear to everyone? Very simple. On a daily chart, it can be pretty straightforward. Price action, candlestick patterns at fib levels, and diversions would be an excellent confirmation for reversals. All right. We remove those fibs once again. We keep the fibs on until a bottom or top is broken. All right. So basically, this fib would stay on. This fib stay on, right? These are the two fibs. Then this top gets broken. All right. So we'll move that fib to the new top like that. This bottom gets broken. So we take away this fib. Obviously, that fib is broken. All right. We keep this fib until the target is hit. And we see a new swing high, swing low. For instance, here we see a new swing high, swing low already forming. All right. So we put that new fib on. And we might add a counter trend fib when we see a clear swing high, swing low into the other direction. Is that clear? Does anyone use fibs in their current strategy? If yes, they are very useful for any strategy. And I think that on the daily chart, you can really focus on fibs. Now, it might take a while, of course, before this happens. I mean, we're looking at basically a year of trading, of course. And there are maybe, I don't know how many, 12 fibs. So on this chart, or I don't know exactly, 12 to 20 or something like that. So, on the dollar yen, there are maybe 1.5 opportunities per month looking at this quickly, right? But of course, the dollar yen is just one currency pair. And so, of course, we can scout and look at other pairs for more opportunities with daily fibs. Of course, we have to realize that daily charts are slower. Obviously, we're just having one candle a day. So If you're looking for a very intensive way to trade, if you're looking for a lot of trading opportunities, then you just need to look at more currency pairs to increase that opportunity. There's nothing we can do about it. But the quality of the setups, though, and the ease maybe of trading is a bit better, because of the fact that everything is quieter. There's less, volatility. We're maybe stressing ourselves less by looking at daily charts. But it all depends on your character, depends on your trading psychology too. Some of us like to be a bit more involved in the market. Others like to be indeed a bit more aloof. So typically it is a bit easier to be aloof than involved because the emotions can run higher. But it does depend. Everyone has a different way of looking at it. Everyone is different temperament. So it really depends on that too, what you prefer. All right. And targets, indeed. Ron, a couple of you said that you look at fibs, and Ron also mentioned targets. Yeah, it's great for targets too. For instance, here you can see how neatly price goes to these targets. So absolutely big fan of fibs myself. Love them, use them in my wave analysis as well. I use them for my trading, and I think that they're a great way of using the trade. I just gotta plug in my my battery, otherwise I'll lose you. 1 second, folks. Sorry, 2 seconds. All right, I'm back, folks. Sorry about that. So yeah, fibs, absolutely a big fan, very big value, and just make sure that you don't move those fibs too early, and keep those fibs on until the top or bottom gets broken, or if fib gets hit, the target gets hit, then you can move those. All right, so let's take a look at the next one. Alligator, AO, Keltner, and Candlesticks. A bit more to look at than fibs. One thing here, a bit of a combination. So Alligator are these three lines, the green, red, and blue. Those are moving averages made by Bill Williams. It's a specially designed indicator from him. You can find it in your MT4 as a standalone. So if you add Alligator, you get all three moving averages on your chart in once. And basically what they say is that what they show is that if there's increase in the gap between them, it's volatile, there's momentum. If they're kind of like in this box here, this black box, if they're going like intertwined and going sideways, it's a range. So I added the oscillator, the Keltner, and Candlestick. So this gives you quite a lot of opportunities, I think, to scout for potential setups. The Keltner basically is great for breakouts. If the candle low, for instance, or high is the candle low is below the Keltner with the close near the low, especially if the Alligator is flat like this, you'll get the expansion. Once you get Alligator that is pulled away from each other with good gaps and price goes back to it, that's typically a good pullback level. If price is basically in a range like this black box and price is fighting against this Keltner but not able to break really through it, it could be a good ranging setup. So depending, basically, to make it simple, but depending on the Alligator, whether the Alligator is trending or not, we could decide how to trade it. If the Alligator is trending, we can look for breakouts. Sorry, we can look for pullbacks. If the Alligator is in a flat situation, basically we can look for the first breakout, or if it's kind of consolidating like this, but then breaking out again, those are periods where we can look for breakouts of Keltner. And on the other hand, if it's in a range, we can look for bounces off Keltner. So depending on the Alligator state, right, is it flat or momentum? If it's momentum, look for pullbacks. If it's flat, we can look for the breakout or for the bounce within the range. All right, so basically Alligator first for the trend, second Keltner for bounce or break or pullback. And the candlesticks we can use to basically understand, of course, how price is reacting to Keltner at those key levels. So this is using those ideas mentioned at the beginning, right? That looking for decision zones and triggers. So the candlesticks are the triggers. The Keltner, in a way, is the decision zone, right? So Alligator is trend. AO is momentum and divergence, for instance. And of course, and Keltner is decision zone, and candlesticks is trigger. So each has their own role, like this. And I think that even using a couple of indicators like this is perfectly fine when we are looking at all these steps. So this is a bit more crowded, maybe, but each has its own specific role and should be fine. So it depends on what you prefer. Some traders are going to like fibs. Some like this perhaps because it gives a bit more. You don't have to draw the fib. You don't have to remove the fib. Everything is on that you need without having to update anything. So some are going to like this. Some of you are going to like the others a bit more. Yeah. So the stop loss, if it's a breakout candle, I like putting a tight stop loss above the breakout candle, high or low, of course, for up, high for down. If it's a pullback, basically I like to use the fractals or key tops and bottoms here. And that can be tricky, especially if you get a bit bigger correction like that. So mind you that sometimes the first trade, if the stop loss is not wide enough, could end in a loss, but then the second one will have to compensate that. With regard to bounce trades, I'll just be looking for a bit, above or below the Keltner and candle. All right, so that is the basically pretty simple here. But with a breakout candle, I think that if you use a high or low or top or bottom, then the stop loss is going to be quite big. So in that case, I use the breakout candle instead. I do use, in that case, though, tight trade management, because if the trade doesn't go my way quickly, here it does, right? So that's great. But otherwise, if it doesn't go my way quickly, there could be a bigger retracement, and then my tight stop loss is running into problems. So it needs to go quickly my way. Once it does, I can move it to break even, and I can give the trade again some space. Here, for instance, is a breakout candle 2 right here. Trade goes quickly my way, and I can move the trail and lock in some profit there. Using daily highs, especially with a breakout, is a good trail stop. In a pullback, I tend to be a bit more patient at the start and tighten my trail if I think that price is making a new low or getting close to the target. Do I place my stop above the swing high, swing low, or above 78.6%? So let's take a look here. It depends. Like if I would be using a pending order on a daily chart, I might go above the 78.6 fib. But I would like to see some confluence. I would like to see a reason why, besides the fib, why price could turn here. If I'm using lower time frames, I would tend to go above the actual top or bottom. But on a daily chart, using a pending order at the 61.8 with a stop loss above that, it could be 300-400 pips. It's quite large. So that's a pending order. If I use if I wait for two candlesticks like this or candlestick pattern to appear, then typically using the top itself is okay, is enough. So then it depends on where the price turns. Now in this case, it turned at these fibs, or let's take a look at this. Let's see here, right? In this case, I wouldn't be putting the fib up here. I would just be putting the fib up here. So it depends on where the turn happens. If I wait for candles to confirm the turnaround. All right, next one I wanted to show you is moving averages and candlesticks. Also one of my favorite ones just the way like fibs. Moving averages are, I think, really super cool. I'm a big fan. I know that, maybe some of you think that they're only for beginners. Ironically, maybe beginners do start with them, then give up on them, and perhaps then later on go back to them because, but in a different way. So moving averages really give a lot of potential for trades. Just looking at the chart, you got many ways of trading this piece of market structure, and the moving averages, all of them, dissect that so nicely. And the cool thing about using moving averages is that you're trading the waves subconsciously without even having to know that you're trading the waves. And that's so cool about the moving averages because you do it automatically. So that might scare you, but don't. You don't even have to think about waves or wave analysis. But by using moving averages this way and by looking for trades with this market structure and focus in mind, you do trade the waves without having to necessarily be a wave expert or anything have to remotely to do with waves. So that's the hidden benefit. So with that said, let's take a look at how this is traded. There are three ways of trading with the trend. There are 2 ways of trading against the trend. I guess you could trade ranges too, but typically most often or not, it's the most difficult. So with the trend setups, let's start with that. It's the simplest to see. Basically, what you're looking for is the moving averages to be pulled away from each other and for price to be pulling away from those moving averages. So when we have the purple ones here, that's long-term moving average. I use 144 and 169. All right. And I use a short-term band for 21 EMA. These are closes. And 21 EMA close, but also a high and a low. All right. So that's why you see 3 moving averages. They create what I call a band. And that band basically, is a rough indication, a rough zone of where price can turn, pull back to before continuing with the trend. So a trending situation occurs when these 2 are aligned, as you can see, when they are obviously both bearish angle. Okay, that goes without saying. This one is basically 21 is pulling away from the long term, so you can see that the gap here is growing, for instance, right between them, and you see the price is below it. So that's typically where price is trending. If the moving averages are on top of each other, price is ranging, and if price is going back to the moving averages, like here in the left corner, or even here or here, that's when price is going back. Price is then retracing within the trend. All right. The trend change happens here when we get a crossover of the 21, below the 144. Before that, we're in uptrend. Here they're in a range, and after it crosses, we're in a downtrend. All right. So that's just the very kind of quick explanation from it with the trend setup. Reversals, all right, are when price, once again, and retracements are when price goes back to the moving averages. That happens in basically 2 phases. One is where price goes back to the 21 EMA, and the other is when price goes back to the 144 EMA. All right, so price will obviously first naturally go back to the short-term moving average and eventually go back to the long-term moving average. Those are the 2 reversal trades. The first one is trading it to the short term. The second one is trading it back to the long term. When price is going back to the long-term moving average, it will typically then be on the opposite side of the 21 EMA. As you can see here, in this part, price is below the 144. The 21 EMA is below the 144, right? The short is below the low. sorry, the short is below the long term, but price is above the short term. All right, so that's basically retracement. So we have two retracement trades, once again, back to the short and back to the long term. So those are two reversal trades. The with the trend trades are, one is basically the continuation of the reversal. One, here we have a reversal trade, step 1 and 2 already in it. Here price is ranging, and here we get the first breakout. So here is the first with the trend setup, when price for the first time is going into the new direction of the trend. The pullback to the 21 EMA is the second setup, and you probably guessed it already. Here there are more second setups. There could be multiple of those. And then eventually we get a pullback to the 144, which is the third setup. All right? So the breakout is the first, the lighter pullback is the second, and the deeper pullback is the third, whereas the reversal trades are the 4 and, let's say, 4 and 5. All right, so here you see 5 different types of setups. And now those number 2 pullbacks, those lighter pullbacks, they can happen a couple of times, but eventually they run out of steam, and they're not as reliable. This one, when we have, this is the first one, the first pullback to the 21 EMA, is often the best. The second one is okay. The third one is typically less interesting. And why is that? If I just add a quick reference to wave analysis here, not that you need to know this for trading the strategy, but that you understand the concept behind it. If you have a 5-wave up and you have an ABC correction that corrects those 5 waves, right? 1, 2, 3, 4, 5, A, B, C, right? If we think where the moving average would be in relationship to these 5 waves, then you understand that the lighter pullbacks will not happen too many times. They will happen a few times, but eventually you're going to get divergence between these bottoms here or tops, and you get price is going to make a bigger retracement. That's because it's going to run out of steam, and wave 3 and 5 will have divergence. That's why you have wave 2 and 4 pullbacks, right? But you might have even extensions. You might have even a wave 3 that's extended like this, for instance. Right? So you're going to have some pullbacks to the 21 EMA here, right? But eventually you're going to run out of those, and the next one, it will break below the 21 EMA, right? The 21 EMA could be like this, and then it goes down again like that. You see? So this basically is trading an A, right? That's a reversal. This is a B. This is trading a C. This is trading the wave 1 breakout. And here you have maybe a wave 2 or 4 pullback, right? And here maybe a wave 4. I'm just doing it very quickly here. It's probably not correct, but you get the point. You don't even have to know the waves. That's not the point. I just want to show you how basically there's how you can this basically shows how you can benefit by using moving averages. By extra benefit is that you basically trade the waves without even knowing it, without even having to know it. So that's the cool thing. And here you see why. That's why, though, you want to be careful with these pullbacks. The first few work well. Eventually, you're going to have a bigger pullback to the long term where you should expect it. There's divergence. So you don't want to keep trading too many of these pullbacks because you're going to hit your head at one point or another. The trend can continue for a while, though, especially on pound yen, right? So we don't want to stop too soon, but you want to be aware of that. How to trade it, though? So now you see the market structure, you see what I was talking about, but how do you really trade it? The candlesticks are the confirmation, folks. The candlesticks are the trigger, basically, the triggers that are the most beneficial. Moving averages are the decision zones. The trend as well, the momentum. They basically give us the analysis. They give us the decision zones. They're all in one. So they're very multifunctional, and therefore I think, although there are a lot of moving averages on this chart, they do have a lot of purpose. There's a lot of things we can do with them. The candlesticks, however, are the ones that are the triggers. So, for instance, here a candlestick pattern like this, showing the end of this impulse, or here, right, that would be first reversal back to the 21 EMA. So the first reversal trade is based on candlestick patterns that show momentum is finished. When momentum is finished, we see a big pin bar. That could be the reversal sign we're looking for price to go fall back to the mean, to go back to the 21 EMA. All right? So that could be a bit dangerous. We know how the trend and momentum can push. So a candlestick pattern could be very useful, but some other things could be good too. Support or resistance might be very beneficial. Divergence before trading a reversal like that. The second way of catching the reversal is a break below the 21 EMA. Here a candle close below it, here a candle close below it. Those would be potential reversals. Now here you have a candle close above it too. But here's the difference. We know that there was strong momentum here with no divergence. So we do not, also, this is the first attempt of price to go back to the 21 EMA. So those two factors together is reason not to touch the upside here. We don't want to trade the upside here, all right? Here there could be divergence and there could be a reason to trade this one. Or here this is the second attempt plus divergence, even better to trade the second reversal there. The same is valid for breakouts and pullbacks. As soon as we have two candles here at the 21 EMA or a candlestick pattern, those could all be, here's a candlestick pattern, those could all be reasons to trade basically the pullbacks with candlestick patterns. Or the breakout, we're looking for basically a candle close near the low, breaking below the 21 EMA. In that case, often it's good to have a Keltner for the breakout too. I would add, in this case, add the Keltner. What I'm looking for is a good candle close near the low and poking through Keltner or below the Keltner to get a confirmation. All right, breaking below the moving average in itself is, in such a scenario, typically not enough. It could be enough, but adding the Keltner, I think, is a good extra and is often the moment where price really starts to become impulsive. So for that particular case, Keltner is a good addition. For other bounces, basically, at the 21 or even at the 144 EMA, waiting for candlestick patterns or two candles in the opposite direction is the trigger that I typically like the most. And the last one, Ichimoku and CCI. All right, so Ichimoku takes the role here. Oh, by the way, regarding stop losses, candlestick patterns, tops and bottoms are typically the best, I would say, for those stop losses. TPs, by the way, reversals, I think is maybe logical already. You can guess that probably. The moving averages, right? That's the target. For breakouts, pullbacks, shallow and large, we can't use the moving averages for targets, but so that would be either trail stopping it, using moving averages, using fractals is one way, or using the fibs, or using strong supportive resistance levels from daily charts, round levels, those types of things. The thing is that in this case, price is moving away from the moving averages, so we can't use those moving averages for targets. We're going to have to use other things. All right, so let's move on. Ichimoku and CCI. So Ichimoku takes the rollover from moving averages and explains how we can dissect and understand the market structure. CCI is in a way like a trigger here, so it's a bit, in a way, the opposite of what you typically would expect. In this case, simply said, is that we're looking for price to, let me get rid of this chat box here. Good. What we're looking for is a trend. So that is when the Kumo cloud, as you can see here, right? All right, its price is below it for a downtrend or price is above it for an uptrend. That's the simple way of looking for the trend definition. All right, and what we're looking for basically is within the trend for price to pull back this in the CCI to above the middle line or below it. So for a downtrend, we're looking for a move above the zero line. An uptrend back down to the zero line or below it. And we're looking for the CCI to turn. So basically, in this case, here we have a downtrend, right? So we see the CCI pull back and turn around, let's take a look, around here. So that would be the entry for this continuation. All right, so ultimately what it's all about is identifying trend, waiting for pullback, and trying to take the trade as it completes the pullback and starts moving into the new trend direction. All right, in an uptrend it would look like this: trend, pullback, continuation, and the idea is to trade the first start of the continuation. So let's take a look at another example. For instance, here you can see, right here, now that entry didn't go anywhere actually, right? So that would have been a loss. Now, one of the ways to avoid losses like this is to see divergence, for instance. And in that case, if you do, that could be a great filter to not take this trade, right? And wait for a bigger pullback. Wait for a three-wave pullback to occur here instead of only a one-wave pullback. All right. So when divergence, yet again, a pattern is so important as always. In an uptrend, for instance, it would look like this. We see prices above the Kumo right here, and it's pulling back to the Kumo, and we see that the CCI has gone back to the zero line. So if it makes a uptick, if it makes an angle go up again, that could be a good reason for a long. So right here, that could be a long potential, and the trade goes our way. Same is valid for here as well. All right, let's see. Now here price goes back in a downtrend. So for instance here, right, a bit further actually, I think. I cannot, 1 second. Somewhere there, looks like we have an entry to the downside. Actually, here we already have a downtick, you see, so that depends where the stop loss is. That could be a win or a loss. The next one is a win because we have plenty of space to move into break even or take profit. All right, so sometimes you get caught in these bigger corrections. That's the only thing you have to be worried about. Well, maybe not the only one, but that's one of the things. But you can see plenty of good moments where the pullback is finished and we get good continuation. The extra tip that might be good to look at is the Tenkin. The Tenkin switching back to bearish, for instance, could be an extra. Or I have here arrows, for instance. That's basically a 3 EMA and 8 EMA crossover, for instance. So that gives sometimes a bit later entry, but it also avoids early entries like here and here, as indicated by the green circles there. All right, so typically the CCI turning is an interesting spot. If you have divergence, don't take the first one though. If you have a first breakout, for instance, here, you might have a deeper pullback. And as soon as price is more an established trend, then taking the immediate CCI turn is often better. Like here, for instance, we have an established trend going on, right? So the first CCI turn here is typically better than if we take it up in here. All right. Now, sometimes taking a trade here too soon is unavoidable, and that's why, of course, when you do get a good run on the potentially second or next setup on the strategy, you need to it would be good to not to quit too soon on this trade. You want to go for a decent run here. You don't want to stay into trade too long, but you want to make sure that you get some profit from this trade to compensate the early entry sometimes. All right, so but that's always like that. You can use also concepts like momentum. This is pretty strong momentum here. This is pretty strong momentum here to understand when maybe price can make a bigger correction. And with some training, you'll be able to sometimes skip those first entries, filter out those, and focus on the next ones, which are often better. All right, now not always the first one is bad, but with a bit of training, a bit of practice, you'll filter out some, and that's already great for the equity curve. Cutting losses in whatever way by skipping trades, filtering out trades, or exiting trades a bit early to avoid a bigger loss. Always cutting losses is always a great benefit. And that's why, if you haven't seen our trade management webinar yet, I would definitely recommend it. We show, my part at least, was talking about the fact that giving trade some basically looking at time, right? If we enter here, and this is the time axis. So let's say the start of the trade, the early mid section, the late mid, and late part of the trade cycle, right? At the start, you want to have, and this is patience, so low patience, high patience. So at the start, you want to have high patience. Then you want to be a bit more demanding, and you want to be in the early mid, because if the trade hasn't gone your way, you want to reduce the risk. If the trade has gone your way, or exit. If the trade has gone your way, you also want to reduce the risk. You want to have a bit more clarity about how this trade is going. If it is going your way, then you want to give it a bit more space again. You want to have high patience because you want it to give some breathing space to go to your target. And once it gets closer to your target, then you want to have less patience and you want to lock in more and more profit. So this is basically the trade life cycle compared to how I am trade managing it, and how my own state of mind is basically in comparison to the trade life cycle, and how it flows up and down like that. So the same could be very well applied for a trending system like this. All right. So if anyone has any questions, feel free to write us an email right there in the middle. If you're looking for the recording, you find it on YouTube. If you're looking for ways to check out more analysis, webinars, and content, feel free to look at our Facebook page, Admiral Markets Global, or just our website, of course, www.admiralmarkets.com, where we have fundamental technical wave analysis, and next week, more webinars coming up. But if you have questions, now is the time, of course, to ask those, by all means, or you can even call us, obviously, here. All the details are here. So of these four, which one do you think suits you the most? Which one do you think fits you, has the potential, maybe, let me say this way cautiously, to which one kind of triggers your interest the most? They're all a bit different and all a bit the same at the same time. I mean, if we look at these 5 points that we had here, basically, sorry, here. All of them fill that in a bit different way. The fibs, really, we don't have a trend method. We just look at the swing high, swing low for trends, basically, right? But all of them basically solve that equation a bit differently when looking at trend, momentum, support and resistance patterns, and filters, and decision zones, and triggers. All of these systems have their own kind of specific mix a bit. So that's always interesting to see how that goes. But ultimately, they all kind of use this blueprint. This is my roadmap. This is the way I try to remove the bias from my trading. Everyone has a bit of bias. Even if you try to remove it, it's still a bit there, but we can do our best to remove our own emotions out of it by following this blueprint, by looking at price and trying to, be an analyst, but then, become that trader and implement that plan, and but without clinging and hoping on to a trade, right? By following this blueprint, we keep ourselves honest in a way and don't get into the trap of hoping that the trade realizes and materializes, because we got checks and balances in place. That's the key. When we have basically a way to, we have like a marathon runner, right? He has a checkpoint 10 kilometers. All right, he knows that there's a water waiting for him, for instance. So we have these checkpoints too. That's when we want to check, are we on the right path? Are we on the right track? Because, for instance, let's say we take a setup and we give it some time, and we have a 10-kilometer checkup, right? And we're looking at the system, and we reanalyze it. We're looking at trade management, and we realize that there are signals that we actually ignored, and if we take those into account, it's better to exit the trade. And this is very important, because often enough we are kind of like overly attached to our trade. Once we enter, we kind of ignore the opposite signals, and once we're out, then we see all those things that we didn't see when we're in the trade. It's just, we have pink glasses on. One of the ways, as I said in the past, one of the ways you can solve that is basically advising yourself as a friend, what would you advise your friend to do? Take that advice for yourself. We often give better advice to our trading buddies than to ourselves. So that would be one way of solving that. These criteria, I think, help with keeping that balance. So let's see, what do we have? We have fibs and the AMA system. Ron uses 6, 13, and 60 with a parabolic SAR on daily 4-hour. Cool, interesting. 6, 13, and 60. So you see, everyone has their own particular setting, and that's perfectly, that's perfect, because everyone has their own preferences, and the MAs, all of them, in my opinion, work. So it's just what you get used to and what kind of experience you build with those. Excellent. So just to recap then, the fib, looking for 2 swing highs, swing lows, waiting for price reactions at those fibs. With the trend one, of course, typically the better one, but sometimes you get the bigger reversal, especially if there's divergence. Once again, we're looking to take away the fib or move the fib. Take away the fib if the top or bottom gets broken, and move the fib if the top or bottom gets broken, and move it, of course, if the target gets hit too. And we're looking for candlestick patterns and targets to get hit, candlestick patterns at those fibs. Alligator, AO Keltner, basically looking for the alligator to understand the market structure, trend, or range. Looking for Keltner for breakout, pullback, or bounce, break, bounce, or pullback. And the candlesticks to confirm that. Moving averages, 5 waves of trading it. We're looking for 2 reversal potentials, back to the 21 or long term, back to the short or long term. That's 1 and 2 basically. And then we're looking for the first breakout, the pullbacks to the 21, and the pullback to the 144 as 3 with the trend setups. Last but not least, the Ichiraku and CCI, we're looking for pullbacks within the trend, and then the turnaround using CCI. So those are some systems you might find interesting or to test. Of course, always try it out on a demo, see if it fits you, works for you. Try to get like 40 trades on a demo to see how those stats are working for you. How is it the feeling with the strategies? Maybe you want to implement some changes to make it more suitable for you, etc. That's always good to test, or maybe you will find out that you want to combine some of these ideas. But those are 4 things you can think about. And Ron is saying, by the way, that the euro pound is hitting exactly the 88.6 fibs. So for those that like fibs, Ron is giving you a interesting fib level right there. So folks, I hope that you enjoyed the fibs moving averages. Those are my, if you ask me, those are my favorites. This one, moving average, and fibs and candlestick patterns in general. Those are just my, my absolute favorite ways of looking at the market. But I like the Keltner a lot too. By the way, this is something that I've been really using a lot recently as well. I should add. And AO, I obviously use that quite often. Alligator I used to in the past. I don't do that as much in recent times, to be honest, but I did in the past. And Ichiraku I did in the past, not so much recently. CCI I did in the past, not so much recently. So these are more older ones I have used in the past. The ones I use more now are moving averages and fibs, which I always am a big fan. So anyhow, that's it. Thanks so much for being here. Folks, wish you all great trading. See you soon. Cheers.